All right, let's jump right into this explainer. Today, we're dissecting the absolutely massive surge of the Unibase token. And then we're going to use a classic investing framework to see, is this the actual future of AI or just a highly sophisticated trap? Unibase has absolutely dominated the charts lately, but as seasoned investors know, incredible price action doesn't always equal structural stability. Here's our roadmap for today. First, we'll cover the Unibase surge. Second, how they're powering autonomous AI agents. Third, we'll ask, what exactly is a value trap? Fourth, we'll evaluate Unibase's structural risks. Fifth, we'll check out what's next on their roadmap. And finally, future utility or value trap. Let's get into it. Section 1, the Unibase surge. Unibase posted a staggering 222% pump in just 30 days. No way around it, that is huge. And this wasn't just some quiet background climb either. A major catalyst for this rocket ship was a new perpetual contracts listing on the OKX exchange. By introducing up to 20x leverage, it basically exposed the token to a massive base of high-risk traders. You know, this kind of tier 1 listing event. It's absolute rocket fuel for short-term price action. But if we look closely at the underlying data behind that price action, things get pretty interesting. Normally, when we evaluate healthy, sustainable mid-cap projects, we want to see a daily trading volume sitting comfortably around 5 to 15% of their total market cap. Unibase completely shattered that ceiling, hitting 20.9%. While that sounds super thrilling, on-chain analysts are actually warning that this heavy tipping of the scale signals intense and potentially unsustainable speculative activity rather than organic growth. Moving on to Section 2, powering autonomous AI agents. So what's actually driving all this hype? Well, recently, Unibase launched the ERC 1883 agent service market. Think about it. Traditionally, AI agents are just siloed chatbots, right? Helping us rewrite emails or awkwardly apologizing when they don't understand a recipe. But with this new marketplace, agents can actually register as verified autonomous on-chain workers. They aren't just answering questions anymore. They are actively hiring, paying, and interacting with each other via smart contracts. It's literally an entire machine-to-machine economy happening in the background. To actually make this autonomous economy work, Unibase built a very specific 3-part architecture. First up is Membase, which solves a huge problem, agents forgetting past interactions, by giving them secure, decentralized long-term memory. Second is the AIP protocol. This acts kind of like a universal translator, so agents across different platforms can actually communicate with each other. And third is Unibase DA, a high-speed data availability layer exceeding 100 gigabytes per second, making sure the network can handle massive traffic instantly. Together, these are what make true AI interoperability a reality. And, you know, they aren't just building this tech in a vacuum. They're plugging it into the real world right now. We've seen the integration of the Hermes AI agent, which uses Unibase to actually retain the skills it learns over time. They've also launched the X402 service on the BNB chain, so these agents can pay each other without worrying about crypto gas fees. Plus, there's a notable partnership with BlazePay, an AI DeFi copilot with over 1 million users. The end goal here is crystal clear. Convert this awesome tech into real, fee-generating transaction demand for the UB token. Which brings us to Section 3. What is a value trap? Right at the peak of this technological hype, we really need to shift our paradigm to a foundational concept heavily discussed by analysts at places like The Motley Fool, the value trap. So, what is it? A value trap is an investment that looks absolutely fantastic on paper. Maybe the valuation metrics look like a total steal compared to the tech they're building. You think you're getting a massive bargain. But in reality, the asset is fundamentally flawed. It's a trap because the price is low for a very good structural reason that the broader market is just ignoring. In traditional finance, the classic warning signs of a value trap include wildly inconsistent profits over multiple years, repeated struggles with cost management, poor long-term planning, or institutional investors quietly heading for the exits while retail buyers rush in. Now, obviously, crypto projects don't have quarterly earnings reports in the traditional sense, but we can easily adopt this framework. We just need to evaluate the on-chain data, token distribution, and the overall structural tokenomics. Let's apply that in Section 4, evaluating Unibase's structural risks. When we look for crypto value traps, the number one thing we look for is a massive dilution overhang, and Unibase has a glaring one. Just 25% of the total Unibase tokens are currently in the circulating supply. A staggering 65% is allocated to the team, advisors, ecosystem, and treasury. Because so few tokens are actually out there right now, the fully diluted valuation, which is what the market cap would be if all tokens were released, is 4 times higher than the current market cap. And here's the kicker. Those locked tokens, they don't stay locked forever. Subject to an 18-month cliff, a 24-month linear release schedule will soon kick in. This means a relentless, steady stream of new tokens is going to flood the market for years. For the token price to simply stay flat, let alone go up, the actual demand generated by the AI agent network has to completely outpace this massive inflation. It is literally a structural tug-of-war. Adding to this potential trap, on-chain analysts and security researchers have flagged a severe centralization risk. As highlighted by the MOEW agent account, the team currently retains the ultimate power to freeze and mint tokens. They have not renounced this authority via their smart contracts, and there's zero liquidity pool value. This introduces a central point of failure and massive potential for manipulation, which is a huge red flag for long-term institutional stability. So, by weighing these factors impartially, the real battle happening behind the scenes becomes remarkably clear. On the bullish side, you have some incredible tech milestones: a live agent market, massive OKX volume, and over 12.4 million testnet memory entries proving the tech actually works. But on the bearish side, you have the classic makings of a value trap, 75% of the total supply waiting to unlock and dilute the market, central authority risk, and extremely high speculative volume ratios. Section 5. What's next on the roadmap? Because the project is in an absolute race to build real utility before those heavy token unlocks begin, we have to watch their timeline closely. The agent market launched in May 2026, but the real make-or-break moment is the AIP 2.0 release slated for the second quarter of 2026. This allows for true cross-platform memory sharing, and it's what could theoretically drive the massive real-world protocol fees needed to offset that upcoming inflation. Further down the road, they want to scale to a 1 million memory nodes initiative to truly decentralize this infrastructure. And finally, Section 6, future utility or value trap. I'll leave you with this final question to ponder. Will Unibase execute perfectly, drive massive adoption, and successfully power an entirely new economy of autonomous AI agents? Or is this massive insider supply allocation and central minting authority just a high-tech value trap waiting to spring on retail investors? I hope this framework helps you cut through the hype and evaluate these complex ecosystems for yourself. Keep learning, keep analyzing, and we'll catch you in the next explainer.